right, good peoples. Here we are for CONY and our underlying coin. All right, so we had an up day, 2.54% in coin to 231.51, and we went up a little more than half of that, right? 60%, 1.4, because we're clearly capped. Okay, so let's talk about this. So no new trades, although 200,000 shares, that's not much for the size of this fund, but they continue to get cash coming in. So they didn't put any new trades on. They sell more shares tomorrow, they probably will. So, we're not performing badly. It's the classic problem here. They can't get out of their way with these underwater weeklies. Now, we did, and remember, when we set on these 220s, we're above 220, so we make as much or more than what our loss is. But we're not knocking it down. So let's go and take a look at exactly how that loss looks. Because the new formats that I've had over the last week or two really help you understand. So this is our synthetic. I mean, I could go over there and show you on the synthetic page, but you got a summary of everything here. Just so you see that it's identical. There's 30.5 in the gain. And if we go over to our 220, you see the 30.5, right? All I do is plug in these new values. And that gives me, we've collected nice revenue here, right? By selling these. I thought I'd updated everything, but there was one that got away. Doesn't really affect a lot. There's the 9.7. So I can tell you everything I need to tell you between holdings and payments. So here's the essential summary. And I apologize for a little bit because sometimes I use terms and people hear them and they interpret it one way than what I meant. So this big thing I'll say to somebody is, well, we've got this paper gain, right? And it's a real gain. It's like buying the stock at $10, having it go to 14. So I got a $4 paper gain. But if I don't sell it at 14, I didn't get the $4 cash gain, right? So that's always what I mean. And remember on the synthetics, they typically are 2 months out when we roll. Sometimes, like if we were to roll right now, and we went to a 230 or a 240 from the 220, we would just go to 719, right? But if we were in early or mid-June, we'd go to 719. But once they're going to be done with 719 and it's 710 or 712 or going into the last week, they're going to then go out to September and do something on the third Friday of September, right? Without knowing that date, I'll make it up and say it's 9/18, right? So the problem with the synthetics, unless you roll them, right, you don't get to collect that cash, whereas on the weeklies, they hit every single week, right? They expire, so if you're losing, you buy them back for a big loss. If they're winning, you buy them back for pennies, and you kept the money they gave you the day you sold them, right? So that's why the synthetics, they need to be bought back, or what we call rolled, right? And sometimes you buy them back and it's a loss, right? But when you're above the price of the strike, it's almost always. So here's another little graphic. I've been keeping these. This is back when we had a different strike price. But once we rolled into the 220, we started to move up. So as coin runs, right, if it moves up too much, it hurts because these fund managers are very conservative. They're trying to get 2%, right? 2%. And they're trying to get these small yields that add up over 52 weeks to a really high yield value. And when they play that game conservatively, and you got a Coinbase or a Mister or some of these high-flying stocks, Nvidia, like today's earnings, those things are going to run right past these. So anyway, enough of the teaching on that. Here's the problem. Great, we got 30 million gain. That's fine if we had a bunch of revenue in the weeklies, but we don't, right? So let's take a look at those. I'll explain each one and what's going to happen, right? So this is the newest one, small amount relative to the big guy, right? So why is it 715 when the stock's only 231.51, right? Go back to May, 231.51, right? Because that's time decay, that's time premium, right? So that should be $1.51. Well, if that's $1.51, we're going to win some on that, because what did we sell that for? We sold that for $2.43, so not a lot, right? So we can go to $2.32.43 and only give the money back, but we don't want to. We want to stay at $2.30 or under. So maybe we received, okay? But maybe not. But that's not the bulk. Here's our problem, right? So let me give you the best case scenario. So I'm going to sum up if we had to close it all today. Okay, so we got this $30.5 million gain. And we've got, now this is inflated by a couple of dollars with time premium, 222.5, right? We're at 231.5. So we're $9, right? Just in, it's never gonna, that's never gonna go away as long as we stay at 231.50. So if this closed on Friday at the exact same price, this is $9, right? Well, if this is $9, right, with my formulas, we don't lose 25 million, we only lose 20 million, right? But we collected 7, but we got to spend 20, right? So technically, we're spending another 13 plus, right, to buy it back. But that's the best case scenario at 231.5. So hopefully, as I use these teaching, you guys start getting a feel for how these options change, right? Because there's only 2 components in an option. Time, right, as you get, so you decay away the time premium as you get to expiration, but you always keep the amount above a strike price or below a strike price, depends on, if you're selling or buying. So this guy is really getting killed, right, to 215. But again, they're so small, they're not our biggest problem. But when you add them back, right, when I make this 11, whatever it was, 475, I think. Yeah, 1147. I'm looking at another sheet on my other monitor. Okay, so here's the problem. We got 30.5 in profits, right? But that's also the exact profit right now. That'll increase because this decay out to 719, but it's only going to go down cents, right? When you have 2 days left, all the time premium, half of it's going to go tomorrow and the other half on Friday. This has a long way to go. So we're going to gain a little bit more every day we go if the prices all stay the same, right? But we'll also lose a little bit of the time premium up here. So it's about a wash. If we go up in coin, this goes down, which is what we want, and this goes up. And that's what's happening. We're making money. All right, so here's the net. We could get this down a little bit, but if we fly up to 240, we're going to make it here. But now this guy is further behind, this guy's further behind. So this is never going to change unless we just ran down to 222.5. And I don't think we will, but who knows? We got really lucky last week. And even if it did, we're going to lose it over here. But that's probably okay because this is money that we get right now. So I wanted you guys to really understand that. So that's why I'm harping on this and showing you, okay? So there's no way out of it. It is what it is. So we closed at 23.24, fair value price, adding 200,000 shares and all of our treasuries and interest bearing, 4 and 5% interest monies. But it's millions, right? So it does add up. It says we're 23.19. Okay, so we'll go to holdings in a minute. I just wanted you to see, I think, how important this page is and how it really tells you what's going on, right? So this is something that, there is some premium in this, though, even though this isn't a big amount of money, 215, 230. So this should be 16 bucks, right? So it's only got a $1.55 premium. So it's something that we got paid 110 and it's 526 now, right? And everything has gone up, right? This one we got 104, but because it's way up to 230, we only have to buy it back for 3 times what we got paid. This one's 5 times. So you see the danger of when this thing runs beyond. Okay, let's go look at payments. I'll give you my best payment guess right now, and then tell you what could happen to alter it a little bit. And some of it comes down to the fund manager, what they want to do. I can almost guarantee you that it won't be under $1. I know all of you are like, oh my God, it hasn't ever been under $1, right? This is where they made $1.57, but they lost $3.32 over here, and they paid them $1.07. That's the classic 2/3 payout, which I kind of thought they might do that last month, but we had a win over here, and they went and borrowed some money, right? They went and borrowed 50 cents out of here. So we got 17 million to carry over. But guys, that's not what it used to be. We've got 22,950,000. So I would have to do a divide, right? I'd have to take this number and then do a divide by this number and get a percentage. Whoops. Yeah. Problem is I don't have it where I got to make it green, right? Right now it's just black writing. There we go. So if we use that money, then we got 77 cents to get added, right? If they used the full value of that. But they've lost 263 over here on the synthetics, right? And now that would change if we roll and bring that down, but that's also gonna hurt this, right? So any way we do it right now, this is about all the money we have, right? And they could utilize a little of this, but they don't want to take away that reserve because we've got a loss over here. So we could just get a dollar. We could get $1.10. Here's how they could benefit us. They could benefit us by the fund managers wherever we are, right? If it runs to 230 or stays at 230, we eat that money that I explained to you, right? A little bit less, say 25 million, 24 million. We keep the 30 million, and maybe they roll it, because remember, they have to take that cash out of other cash, and they don't really want to take it out of treasuries. They want that to keep earning the 4%. So what they'll do is they'll roll that synthetic, capture 30 or whatever it is, and use that to buy those calls back. Now they got a new week, but the problem is on Friday, as they're doing that, they got to go ahead, and let's say we're still at 230. They'll probably go out and get a 240, and then if we run like crazy, we're going to be capped again on the following week. So I think they should give up some income potential and get 8 cents or something. Get a small amount, but go out to a 250 or 260 so you don't get run by. And when you don't get run by, you don't lose, but your synthetic kicks butt, right? I mean, think about that. We're making 30 million in the synthetic, but we're losing 26 million on the weekly. So what's intended to help you, which is a conservative to keep you within the money when everything's going down, turns around and is like a boat anchor, right? You're dragging that heavy weight. So it's just the yin and yang of what happens in the way these things are played. They do need some kind of protection. They do need a vehicle to collect some weekly income. But boy, is it painful when the underlying is doing pretty well. So let me go show you on the weekly my chart. I updated the chart. So this is nothing more than saying, hey, we got 7 million at stake. I don't even keep updating this number, right? Because honestly, it just keeps running, and the holding page helps me a lot better. We're 65 of 1% under this one, right, at 231. This one we're way under, and this one we're pretty far under. Based on the chart and what I see, I mean, it's some possibility. We got this flag, right? We could draw a parallel line here. But the whole point is the flag is flying on this flagpole, and it's going to break out. Well, guess what? We've broken out. And usually it comes back to test. And if you look at the lows of the day, they are. So as long as we stay above this line, which the line over here where we're at is about 218-ish, right? We remain bullish. So that would certainly help this call. But do I think that's going to happen? No, but anything's possible. NVIDIA earnings were good. That's sort of a risk on. Let's see what happens. And you know, as lucky as they've been, like last week, pulling back and getting underneath, right? It's just, I don't want to see us run down to 210 because we're going to invalidate the breakout, right? And I'd like to keep the breakout, but I don't have a problem having it go back to 218 or something, 220, and close there on Friday, or sustain it long enough that they can buy it back for pennies, right? And they're going to reduce the synthetic, but so what? They don't need to capture or roll it if it's staying around 220. So that's the whole scenario. Right now, I'm seeing $1, maybe $1.20 or something. I'll keep you updated as we go, and sort of hopefully that helped for you to really understand what you're up against, right? It's this ugly synthetic that we had to buy back before, right? That hurt us. And you know, we have some money here, but as share count goes, you just have to have a lot more if you want a big payout, right? This was $1.76 and it became $2.28, but look, it had money over here. This was only 5 cents, but look at the money there, right? $6.40. So you see situations here, they got $6 loss. They had no money to be paid, but they went out of the almost $4 and paid $1.66. So every scenario, and these matter a little bit, these carry forwards, right? You don't want this debit one hurting you, but when you get the carry forwards over here, and the only reason this one is so big is they're not done. Once they do a distribution here, this shrinks tremendously, right? So this one is setting at 17 million over here, but with this ugliness of 81 million. So that's all I got. This is Bruce out. I'll try and get Misty out before long. I got YBIT already. And GDXY, guys, don't forget about GDXY. When it goes on sale like this, it's only a matter of time before those super undervalued gold and silver stocks take off for the moon. So I'm very bullish on that. If you saw my YBIT is starting to really perform with crypto. All right, guys, that's all I got. Again, this is not financial advice. I'm not a financial advisor. This is for fun and education. See ya. Bye.